All right, welcome to this explainer. Over the next few minutes, we are going to break down all the recent volatility that's been shaking up the financial markets, from stocks all the way to crypto. It's been a pretty wild ride, so let's try to get some clarity.
Okay, let's just dive right into the big question. Because let's be honest, this is what's on every single investor's mind right now. After such a strong run, these sharp drops can feel, well, pretty alarming. But do they actually signal a real long-term reversal? Or is there something else going on just beneath the surface?
To really get to the bottom of this, the first place we should look isn't the price charts. It's the emotion that's driving them. Because in the markets, how people feel can often tell you a completely different story than the headlines. And right now, those market sentiment indicators, they are flashing bright red. For an asset like Bitcoin, we're seeing readings of extreme fear. Scores have dropped as low as 16 out of 100. That is just a deeply, deeply pessimistic reading. It's the kind of number you see when people are scrambling for the exits.
But here's the really interesting part, the part that seems totally backwards. This level of panic is often a contrarian signal. Just think about it for a second. When do major market tops usually happen? Amidst euphoria and greed, right? When everyone is convinced the party is never going to end. Widespread extreme fear like this, that's typically found way closer to market bottoms, not at the beginning of some huge collapse.
Okay, so if all this fear doesn't really signal a top, what actually caused those sharp drops we just witnessed? Let's peel back the layers here and look at the mechanics of what really happened.
That dramatic plunge in Bitcoin wasn't just about some bad news or a sudden change in the story. Nope, it was a technical event. It started with a pretty healthy pullback, but then the price broke a key support level. And that triggered a domino effect of automated sell orders, stop losses that are designed to protect investors. This created a massive liquidation cascade that just forced prices down, way faster and further than they might have gone otherwise. It was really more about market structure than anything else.
And this is where that contrarian idea really comes to life. While tons of smaller investors were being forced to sell during that cascade, data that we can pull directly from the blockchain, what we call on-chain data, it shows that some of the big, sophisticated players were actually using that dip as a buying opportunity. They literally saw the panic and decided to buy right into it.
And you know what? We're seeing a really similar story play out in the stock market. Take a key AI stock like Nvidia. The popular narrative out there is screaming that the top is in, that it's all over. But when you actually look at the chart, the technical reality is, well, a lot less dramatic. The price is really just moving sideways, kind of chilling out in a well-defined channel between a price floor, or support, and a price ceiling, known as resistance. It's not a collapse. It's more like a pause to catch its breath.
So if these moves aren't being driven by a fundamental collapse or some classic topping pattern, what's the real driver behind all this volatility? What's actually pulling the strings?
Well, first, let's cross a common suspect off the list. Whenever markets get this rocky, people immediately start to worry about the banking system. But when you look at key liquidity indicators, things like the rates banks charge each other for overnight loans, yeah, there's a little bit of tension, sure, but there are absolutely no major alarm bells going off that would signal a systemic crisis.
And what about that recent Supreme Court news on tariffs? It sounds like it could be a negative, right? But here's another counterintuitive twist. The most likely outcome would actually force the government to issue refunds. And what would that mean? More cash, more liquidity being pumped back into the financial system, not drained out of it.
Okay, so here it is. Here's the real catalyst. Just look at this.
A week ago, the market was pricing in a 75% chance of an interest rate cut in December. This week, that probability has absolutely cratered to just 25%. This huge reversal happened right after some key inflation data came in hotter than expected. This massive, sudden whiplash in expectations around what the Federal Reserve is going to do, that's what's putting pressure on everything, from stocks to gold to Bitcoin.
So let's put all these pieces together. We've got the sentiment, the technicals, the macro drivers. What's the final verdict on what's going on in the market right now?
So, all the evidence seems to suggest this isn't the beginning of a new bear market. Instead, what we're seeing is a necessary and definitely fear-driven correction inside of a larger, ongoing uptrend. It got a huge push from those technical liquidations, but the root cause was that sudden shift in thinking about the Fed's next move. The long-term bullish picture, for now anyway, seems to be holding up.
So I guess the final takeaway here is this. This entire pullback is just a powerful reminder to look past the scary headlines and really analyze the mechanics going on underneath. It leaves us with a really important question. In a market that is just filled with noise, is the biggest risk of all just listening a little too closely to the fear?